Hey, what's up guys? It's Andrew here from Pennant Players. Today we're going to be talking about triangles. There are three types of triangles: the ascending triangle, the descending triangle, and the symmetrical triangle, and we'll be discussing all three in this video. Please be sure to like, subscribe, and share if you like the content we're producing. Okay guys, so without further ado, let's get into the video. The symmetrical triangle is a pattern that appears to be, as the name implies, a symmetrical triangle. Neither the support nor resistance is parallel to each other, but rather they are intersecting. So we can see here an example, which is OMI. Now OMI had a spike in price action from 3/13/20 when it rose up until 3/31/20. So we can see here there was an over 146% margin of profit to be made in that trade. But that's not really what we're trading. We're trying to trade the triangle that comes after. Now, what a triangle is the coiling up of price action due to uncertainty about the later price action, if that makes sense. So what's going to happen after a large spike up, it doesn't always have to happen, but it's certainly a very prevalent pattern within the market, is a triangle formation. We see a coiling up of the price action, meaning higher lows and lower highs. So we can see it's forming, this triangle kind of coming inward. So what this can predict is a breakout. Now, a breakout is the breaking above or below of either the support or resistance lines, respectively. So we can see here from OMI that once it reached, kind of towards the end of this triangle, we had a breakout to the upside. So there was over a 17%, 18% profit to be made within this trade by trading the breakout. Now, symmetrical triangles can go either way in terms of bullish or bearish. So when trying to predict a price increase or decrease, whether it's going to break above or below the current price action, mostly depends on the direction from which it came from prior, if that makes sense. So we can see here that this was going to, more often than not, again, it does not have to happen that way. There are examples when, it comes from a spike and then will break downward. So that's something to look out for. It's not a guarantee that this will be bullish, but it is an indicator that it will be bullish because it came from a large spike up and not a large falling price action, if that makes sense. So we can see here that there is, this coiling of price action up through this support level. You can draw like a trend line here and then a trend line down here to see this. And you can see that there's a triangle here. So once it crosses above this resistance level, this is going to indicate that there is a breakout coming. So we can see here, zooming in a little closer, that immediately after it crossed above this trend line, there was a sharp increase in price. This breakout right here, this is playing the breakout. A solid 17% profit right here. Okay, so for a triangle like this, let's talk about entry and exit points. For an entrance point, you're typically going to want to find an entry point that is above the current resistance level. So as we can see here, once it crossed above this red resistance level that I've drawn, it was an immediate spike up in price action, over 18% profit. So this is something we could have taken advantage of by entering just slightly above this red resistance level. And then in terms of exit points, now exit points can be a little tricky because it's kind of like musical chairs. And this is an analogy I quite like to use with trading in general, or even the overall market. Investing, it could be anything with any type of, you know, instrument of finance. So it's musical chairs in that you don't want to stay in too long, or else you won't find a chair. But you also don't want to jump too fast, or else, again, you won't find a chair. The key to this is timing it correctly. So conventional wisdom would typically say that triangles tend to favor symmetry. So it would essentially claim to make a drawing right here of the spike, you know, the prior spike before the forming of the triangle. So from here to here, boom. Now duplicate drawing, and then move this over here. So breakout, it should in theory reach all the way up here, but we can see in practice it doesn't. While this is a great tactic to use in terms of generally gauging how much it can go up, it won't always. And from my experience, more often than not, it doesn't. So what I like to find here is to make a set of rules as to compare the volatility of the stock. So, you know, how much it's trading up and down in terms of percentage, how much it's trading up and down in terms of price, and then make a strong set of rules about when to exit. So, for example, this first spike up, continuing the first initial spike up after a downturn, it's approximately 75%, and then subsequent spikes up were about 40, and then coming into this range is about 22. So I'm assuming that a breakout, if you're trading conservatively, I most likely would have gotten out in increments, probably at the 5 and 10. So 5% and then 10%, and then possibly hold a little more for 15, because that is reasonable within the price action as to what we've seen before. So it's definitely you're going to want to make a structured set of rules, but you're going to want to make that structured set of rules based on the volatility of the stock you're trading. Because, you know, you might say 5% or 10%, but not every stock can reach that 5% or 10%. The same way not every stock can go beyond that. So you're definitely going to want to, when you're setting your exit points from these triangles, you're definitely going to want to base it off of the volatility of the stock, off of how much is trading up, how much is trading down between the support and resistance levels, and also factor in this initial spike. In terms of stop losses, cutting your losses is key with these, because you may think that this will break upward, and it may. However, it may be one of two things as well. It may break down even though this is a bullish move. So it could have just as easily hit this level and then shot this, 20% down. So it could have made the exact same move downward. Okay. Again, while this is a bullish move because it came from the downside up, it had an upward spike initially. That does not necessarily mean that it is guaranteed to be bullish. So this could just as easily break down. So this is why conventionally you're going to want to make your entrance point once it breaks either beneath or above the support or resistance respectively. The triangle in and of itself is typically conventionally considered the no trade zone. And what this means is to not gamble. we're trying to eliminate as much gambling as possible when trading. You don't want to leave it up to lady luck, essentially. So if you're trading for the breakout, you most definitely will not want to trade in the triangle, because that means you are anticipating a move, and you don't want to anticipate the move, if that makes sense, because then that's essentially just gambling. You want to wait for it to break above this resistance level or below this support level and then enter. Now, with that said, there's also many different strategies you can use with triangles. While this is generally considered a no trade zone within the triangle, I find that I can actually get phenomenal consistency of price action, both spikes and falling price action within the triangle, if that makes sense. So while I won't be, now this isn't to say you should trade within the triangle for this breakout, but that's not what you're doing in this case. The strategy here would be to trade in this triangle with regards to the support and resistance levels, essentially making it a channeling stock. So, for example, you may enter somewhere here. See, this is kind of forming a triangle. You may enter somewhere here and then get up on this and then exit right when it hits that resistance level. So again, that is a phenomenal profit to be made, essentially the same as the breakout. And it's very consistent price action, as you can see. It tends to follow these support and resistance lines very well. So that's why I love trading within the triangle, but not for the breakout, if that makes sense. Again, the alternative two things that can happen with the breakout is, this. So with these exit points, it can just as easily not go up to that symmetry line, not go up to that initial spike after. Number two is it can be a false breakout. Okay, so this is an example, perfect example of a false breakout. So what was going on here, we can see that there's a gap to fill. So the technical analysis this initially would be there's a gap to fill here, which means that there isn't any bars. There's no candlesticks here because it immediately went from here to here without a falling price action. It just, boom, it went there. It just opened there. So there's a gap to fill. So there's going to be a tendency to fill that gap. Not only that, we also have an upward price movement, okay? So making this triangle here bullish, and it's in an uptrend now. So all these things combined, this would be a very bullish move. So we'll again do not anticipate a bullish breakout because you don't want to gamble. You can safely say that this is more than likely a bullish move when it forms this triangle. So now if we look here, what actually happened is that it formed this triangle, right? But now it has a false breakout. You'd say, wow, there was a really strong move here. It's in a general uptrend. It's going to want to fill this line right here, this gap. But it broke down. So once it hit, it coiled from the unpredictability of the price action. And then boom, it broke downward at this line right here. However, this was a false breakout. And we will do a video on false breakouts later. But a false breakout is essentially when this triangle wants to break upward, okay? This was the move that was anticipated. This move right here, boom, right up to this line, right up to this candlestick. However, it broke out downward once the coiling of the triangle stopped. However, right after that, it began to shoot up again, a massive spike. So we got that initial anticipated move. We just got it at a later time after the triangle. So this is another thing where you want to control that. You want to see all of the possibilities. You don't only want to see the good, you don't only want to see the bad. You want to see every single possibility, every single outcome, and decide for yourself if the probability is worth it. And to maximize that, again, find that entry point once it breaks above the either support or resistance, or sorry, below resistance. Now, getting back to the typical breakouts you will see, which is the the forming of a symmetrical triangle. Here is another example of SWCH. So you can see we had a large move in price action, and then a coiling of the price here until a breakout, boom, right there. Again, you're just going to want to control this. And now for stop losses. One of the most important things in trading is knowing how to control your losses, because losses are always hidden in your P&L, your profit and loss. So what we're going to do here is, it depends. Your stop loss is going to depend on how many points at which the equity you're trading is hitting the support level. So for example, here, SWCH, this hit it, the support level, about 1, 2, 3, 4 times, 4-ish times. So what I typically like to do is to put my stop loss at either the second or third point at which the support line is touched. So, and a stop loss is an automatic triggering of the sale of your stock. So put it here. This would be a more conservative approach would put it here. And now at this line, if it crosses below this, there will be an automatic triggering for the sale of your stock. Now you could also put it here, and this is a more aggressive approach. And what this does is it protects you against a unanticipated move, yet it's not enough in most cases to stop you out of a false breakout. So I find that putting it either at the second or third point of the support where the price action touched that support is best for stopping these false breakouts. Now, with regard to that, as I said before, there are the 3 types of triangles, but it honestly does not matter. Once you have a triangle, you have a triangle. Well, some can typically be more bullish, some can typically be more bearish. For most people, for almost all people, a triangle is essentially just that. It's a triangle. No matter what shape, form it comes in, it is a triangle. So, example here, ARDX. This was forming a ascending triangle. See, what we can see with this is that the support is at a slope here. The support is increasing, while the resistance here is a parallel, well, not parallel, but it's a flat line. So if we just extend this to the left here, we can see that it's at multiple points, hit that before, and now it's starting to hit that again. So we see this kind of like boom. So this line is flat, the resistance line is flat, and now the coiling up of the price action is going to be up in this range. So now here, up, 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 and then the breakout was to the downside here. Boom. So this is something that's we wouldn't have wanted to trade. We would have wanted to wait for a break generously above this to really see a breakout. And that's why it's good to not anticipate the move, but rather enter during the move. But again, another viable option would be to trade this within the triangle. So you could see it's starting to form a triangle here. If you had bought here, let's say, boom, 16%. If you had bought here, let's say, at this support, and then just ride it up to the resistance, you don't even have to wait for a breakout or anything. Boom, 40%. So something like this is an ascending triangle, and the same works for a descending triangle. Again, a triangle is just a triangle. Every single triangle has the same fundamentals. Some are typically considered to be more bullish, some more bearish, but again, a triangle is a triangle. At the end of the day, the fundamentals of these are the same. So a descending triangle would just be the opposite of this. It'd just be a falling price. It'd be like this, something like this, where you'd see like a boom like that. And now this would be considered more. So it'd just be the inverse, the flip of that. So again, the typical way of thinking would say that the indication as to whether a triangle is bullish or bearish is to see where it came from. Now, if this we can see, this came from the downside. So the anticipation of this triangle would be a breakdown, and we've seen that. But that does not always happen again. If it were the opposite, if this were to come from a massive spike up, then as we saw here, with this symmetrical triangle right in this region, came from a massive spike up. According to the price action, we can assume that this will most likely be bullish. And as it's shown, here it was, this breakout above the resistance level. Okay, now for the remainder of the video, there's three additional things you're going to want to look at with triangles. For starters, one is you're not just going to want to use these solely. Many beginners try to use a triangle as just that, a triangle. But a triangle is just one piece of the puzzle. We're going to want to look at multiple different things. We're going to want to look at indicators, such as the MACD, the RSI. We're going to want to look at the volume. We're going to want to look at general price action. We're going to want to look at prior history. So say we're trading on the 180-day 4-hour chart, we can go back to a chart like the 1-year day to see a general overall trend with the stock. So we can see here that this looks like a great option, but going back in time to the 1 year, we can see that this is pretty overextended now. Once it hit that point, and it's pretty overextended on the MACD. It's topping out right about there, as you can see, right in this region, and it's starting to come down. So it's going to have a propensity to keep going down. The assumption here is that while this symmetry idea is phenomenal, it's not always going to hit that. As you can see here, it didn't. So, and you generally could have suspected that, because there's not even room for a large move like that if you look back in time at some of these later time frames. Because on the 180-day it looks great. MACD's right there, kind of in the middle. RSI is kind of in the middle, right at this breakout. So you could anticipate that, but no, you're going to want to look back in time. The triangle is only one piece of the puzzle. It is not the puzzle itself. So you're definitely going to want to use these with other forms of technical analysis to try and find the best opportunities. Number two, you do not want to confuse these symmetrical triangles with bull pennants. Now, a bull pennant here, this is a perfect example of a bull pennant. Again, we'll later do a video on bull pennants, bull flags, and other patterns of that nature. So um, stay tuned for that. Make sure to subscribe, like the video. However, with bull pennants, you're not going to want to get them confused with symmetrical triangles. Now, bull pennants tend to be more bullish than symmetrical triangles coming from the upside. But what is the difference? Well, it's very easy to get them confused because the name implies that a symmetrical triangle is simply a forming of a symmetrical triangle after the price either sharply increases or sharply decreases. Now, a bull pennant forms a type of symmetrical triangle. However, in like a geometrically symmetrical triangle, however, it is not considered a symmetrical triangle pattern. It is considered its own type of formation. And we can see the differences here. So this is a bull pennant. We can see that it has a much sharper increase in price coming from the downside up. So in comparison, look at something like SWCH, which I showed you before. We can see that this is while it was pretty sharp for a symmetrical triangle, it was still a very, it was a journey. It didn't just rise up like that, boom. You know, we had little pullbacks at times. It rose more steadily. It wasn't, just straight up. So something like IDX, which I'm looking at now, it kind of just rose straight up. There was no steady increase. It kind of just bolted up with a massive spike in the price. So that's one of the indicators that it is a bull pennant instead of a symmetrical triangle. Now the second would be that there is a much tighter coiling of the price action. And what I mean by that here is you can see on the 180-day chart just how congested this is. So if we look at it here, I mean, look at that. This is a 20-day. So this is a 20-day 1-hour chart. We can see how congested this is. The angle of the triangle, while it is symmetrical, is going to be much more obtuse if we look at that in this regard. So you can see it's much more congested with wicks, candlesticks in here, and it's much more of an obtuse angle. It's coming in like that instead of being prolonged and in. So something like this, SWCH, we can see that this is much more, prolonged. It hits, it goes down steadily, it comes up steadily, it's not like that with a pennant. And the last one is volume. So with a bull pennant, typical formation is a extremely large spike in volume, followed by an extreme but steady decrease in volume. So see, we can see a large spike in volume here with this large upward move, and then once it's forming this pennant or obtuse triangle or whatever you want to call it, it goes down, but it goes down incrementally. It doesn't just go straight from the top straight to nothing. It kind of just comes down, and then we'll most likely see a large price action jump here. However, that's not to be anticipated. Again, with anything, we're going to want to wait for that breakout. Lastly, you're definitely going to want to make sure you know the difference between the ascending and descending triangles and falling and rising wedges. Now, the main difference here is that a falling wedge tends to be bullish. It tends to signal a trend or reversal, while a descending triangle from the downside would signal more of a continuation pattern. So, for example, and the same's true with rising wedges and ascending triangles. So here, I'll just delete this real fast. Now, we can see here that what an ascending triangle is essentially just a parallel, or not parallel, but a flat line for a resistance level. It's the price isn't while it's forming a triangle, isn't breaking above that flat resistance level. No change up, no change down. So it's flat for this trend line. What you're going to want to find with these support levels is that they're increasing. So again, you're seeing this ascending triangle formation. But it's important to consider the possibility and to know the difference between that and a rising wedge, because the difference could mean everything. The difference between a triangle like this one, well, not a triangle like this one, because this one came from the downside, so it was generally considered a bearish triangle from the start. However, if it came from the upside like that, then it would have been considered bullish. But if it came from the upside and it was a wedge, it was a rising wedge, then it would still be considered bearish. So that could mean all the difference in whether taking the position or not. So you're going to want to know the difference. And the difference is this. A rising wedge, as opposed to a ascending triangle, is that a rising wedge will look like an ascending triangle. However, the resistance line on the top is sloped. And, this can be very finicky because it's hard to tell the difference, because it might be, just a tad bit sloped. Like here, say if it was like that, is that considered a ascending or descending triangle? And the best measure here is just to use your common sense. I mean, obviously, if it's just a slightly off, that 0% change of flat, then it's a ascending triangle. But a rising wedge will have a slope on the resistance line, so it'll look something like this. Boom. And then the bottom portion of it, the support line, will look exactly identical to a ascending triangle. So we can see here that this, what I'm drawing right here, is not an ascending triangle. Well, this is only slightly off of this flat line. This is a wedge. And now if this came from the upside, if this were a ascending triangle, it would be considered bullish. But because it's a wedge, it is considered very bearish. Now the difference here again is that this is sloped. With a wedge, both the support and resistance are going in the same direction. The slopes are going in the same direction. So the resistance line is going up. The support line is going up. But it is not a channel. A channel would be something like that, where the two lines are parallel. A wedge is when these two lines are both going in the same direction. However, one has a much greater slope than the resistance. And it's the exact same thing with falling wedges. Now, if you have a wedge like this, just kind of basically drawing it here, you can see that how this can be mistaken for a descending triangle. But this is a falling wedge. And again, it's not to be confused with the channel where the two lines are parallel. It's not going to be to be confused with the descending triangle where the resistance line is sloping down and the support line is flat, because both lines are going down. You can see it starts here and goes down here, and this line starts up here and goes down here, but one has a much greater slope. So in this regard, the resistance line would have a much greater slope, and this is considered a falling wedge, and this a rising wedge. Now, a falling wedge is very bullish, and a rising wedge is very bearish. So we would anticipate a break down here and up here, typically from a reversal. So it would enter here, boom, and then kind of zigzag and coil in these price levels, and then break out here to the upside. So that's a reversal, and the same here. Come from the upside, coil up here, and then burst downward. So that's really the main point here, is that you do not want to get confused. You do not want to mess up between the patterns, because it could mean the difference between a winning or losing trade. So thanks for watching, guys. I hope you found this informative and educational. And again, if you like the content, please like, share, and subscribe. Stay green.